Hello and welcome to Options Guy TV. My name is Brian Overby. I will be your host for today's show for about the next half hour or so. I'm also the author of the Options Playbook, and we're going to be kind of talking a little bit about the Options Playbook. Um, I've gone back and forth on when I wanted to start this plan that I have for Options Guy TV in 2024. On Monday's show, talked a lot about the fact that the markets are just kind of boring in that we're really not moving anywhere. We've had the VIX actually come down precipitously ever since the big talk or the big kick appropriations can down the road done by the Congress. And that was when we saw the VIX run up, rightfully so, because there was a potential for a government shutdown in many of the different departments. Now they've kicked it down the road another 45 days. November 11th is supposed to be the other big date. It seems like the markets have now forgotten about the fact that that's happened, but obviously geopolitical concerns have risen. And we still have a lot of issues. First of all, just the appropriations. What type of monies are we willing to pay to try to help fund our allies overseas during these conflicts? And that is a big deal. That's going to be a big part of this budget that's going to come out for this next fiscal year on the for Congress and the U.S. government, just in general. So I've been hesitant to do many things that have been long the market. And we're still in October, as you actually almost said November, but we're still in October. I think I'd like to get to November. September didn't disappoint as far as it was another calendar month in September that the markets underperformed, and it started out fairly decent in September, but then ended up pretty ugly before it was all said and done. October still makes you nervous, but I think I want to start getting long the market a little bit prematurely, if you will. And we're going to do that by managing our risk. And I'm going to put a portfolio of paper trades on inside the TradeHawk software. Today, I'm not in the paper trading account, but I'm going to set this up and get it ready to go. And we're going to try to do a diversified portfolio of long, deep in the money call options on stocks that you may have already in your portfolio or stocks that you might want to own going into 2024. So once again, on Options Guide TV, it's not meant to be a recommendation, but I want to continue to find scenarios that we can apply many of the 40 different strategies that are in the Options Playbook. And on top of it, I want to manage a portfolio of deep in the money options. Now, in my own portfolio, I have a combination of deep in the money options contracts. As a matter of fact, we're going to talk about Google today, and I do own some Google. I own some Google stock, and I also own some Google deep in the money call options that I actually got long after the split. After the split, the stock went down. I did get long some deep in the money going out a couple of years in time call option contracts, and I've been selling some calls against it. Had a couple of situations where I was in danger of the stock getting called away, but we'll talk a little bit more about that as we manage this portfolio throughout time, because Google has actually done very well on a percentage basis year to date. It's one of the Magnificent Seven that, and I shouldn't say Google, it's Alphabet. I apologize. I hope I didn't confuse you there. Most people know who you're talking about, but Alphabet has done very well year to date so far, up about 53% at year to date. So with that said, let's look first of all at the neutral trade that we were looking at on Monday. So inside the TradeHawk software, I'm going to first of all highlight that the VIX has came down. It's down around that 16% level. We looked at the SPY on Monday, and I'm just going to mention the trade because there's really not too much that's going on the trade. On Monday, we ended up widening our trade a little bit because honestly, I couldn't find the 5-point strikes that I wanted. So we did a 10-point wide iron condor, about equidistant in and out of the money on the call side and on the put side. We put that together. The market was at 428. On the day, it was down $1.31 when we did Options Guide TV. And right now we see the SPY at 435. It's up $1. The price hasn't changed. It's basically trading for what we executed the trade for, which was a net credit of $1.60 to the account. So I'm just going to mention that the short call that we sold is the 440, and the short put that we sold is 410. So we're night. So we're sitting within that range, and there's no real reason to go on out and adjust that trade at this point in time. All right. So let's look at our Google trade. So in Google, we're going to go out to the end of 2024. Now, I don't mind. I like to do Google right in this range. We're not into earnings season yet. And if I'm going to be buying my leap option contracts, even though the leaps might not react as much to earnings as the shorter term option contracts as far as implied volatility spikes, I don't want to be putting in on a portfolio of stocks around those earnings because of the volatility. I'm not doing it because I want to get long Google because of an earnings event. If that was the case, I would be looking at shorter term options, and I'd probably be selling some premium against them. So I'm going to go out further in time. We're going to go all the way out to almost the end of 2024, and we're going to buy a Google option contract. We're going to go a little deep in the money. And because we're in October, we're actually going to sell a call against that position. So let's, as far as that trade is concerned, let's zoom out here a little bit. And I am going to go, and I'm going to take a quick peek inside the options playbook here. So let's grab the options playbook, and I'm going to move over the screen. And here we go. Okay, so if we go back to the full screen, here's the options playbook. Let me zoom in a little bit on it. And this is a strategy that I highlighted in the book in the Rookies Corner. This is optionsplaybook.com. This is the companion website that goes along with my book. Every word that's in the book is actually on the website. So buying leaps as a stock substitute. What are leaps? Leaps is just a fancy term for long-term options. Usually they're considered that you go out over 9 months in time, because when they introduced leaps, there weren't option contracts that went out that far in time. And LEAP stands for long-term equity anticipation security. It's just an acronym, and that's it. So a lot of people think that, like, they'll talk about leaps and they'll make a typo because they'll just say leap because they do not know that it's an actual acronym. So just a little tidbit, but that's what it stands for: long-term equity anticipation securities. And that just means option contracts that go out more than 9 months in time. And we're going to go deep in the money. By buying this, if you scroll down and you look inside the options playbook, you'll see that we're going to look at about an 80 delta. So we want something that represents the stock. We're not going to buy the stock. First of all, we're a little nervous about the market. So we're going to limit our downside risk. And our downside risk in general is it's going to be what we pay for the call option contract. That is the maximum risk that you can have when you buy an option contract. But we're also going to go deeper in the money. So by going deeper in the money, looking at an 80 delta, in my experience, it usually means you're anywhere between 15 and 20% of the total risk that you would have if you bought 100 shares of that underlying stock. We're not going to keep all that risk because we're going to also manage it. So if we're down 7 to 9% on our leap option contract, we're going to get out of it. So this is not a strategy where we're just buying and holding. An option contract is a decaying asset. We're going to trade it. We're going to manage it. But it's an alternative if you want to start putting some capital into the markets going into 2024. It's a way that you can dip your toe in the water without all the risk of just owning the stock outright. So the 80 delta, which I'm highlighting here on my screen, is an important number. I want to be somewhere. That means I'm going to get about 80% of the stock price movement. There's many different ways that we can say this. If the stock goes up 1, our option contract is going to go up 80 cents, right? So if you had 100 shares, the stock went up 1, you'd make $100. If you own one option contract, the stock went up 1, you'd make $80. That's in theory. It's a dynamic number, but that's the concept. It gives you a realistic expectation as to what your option might do as the underlying stock moves. Now, I always feel compelled to also say that on the downside because we don't always get it right. The market goes down 1 on our stock, we're going to lose $100. On our option contract, we should lose 80 cents. Now, as we go through this strategy, and the stock is moving in and out of the money, one of the nice things about the option contract is the deeper you get in the money, the higher the delta gets. If you start with a delta of 80 and let's say the stock runs up 4, 5, or 6 points, I don't know exactly where the delta is going to be, but it's going to be higher than it was. And that's the case in the options trading world, is that you pick up momentum if you're correct on your forecast. Now, if the market goes down and starts going towards the strike of our option contract and is less favorable, the delta actually gets smaller. So on the way up, you pick up delta, or you could say you pick up shares because it kind of acts like 80 shares of stock. On the way down, it slows down. And that's one of the nice things about the option contract. One of the bad things about it is you're still paying time decay. You're still paying time premium. So even though you're going deep in the money and that option contract is going to be made up of a lot of intrinsic value relative to a lot of intrinsic value relative to time value, when you go the deeper into the money, you will see that that option contract will act more like the stock. You still have to pay for some time value, but it's not as much. You're getting what you pay for when you go deep in the money on an option contract. You're buying real value. So hence the reason, if we have that time value, that we're going to sell some calls against it. Because one of our battles is that we want to reduce that time premium. That's a battle that you don't have to fight if you own that underlying stock outright. So I like to look at fig leaves, especially in a marketplace like this right now, where we're a little bit neutral. And I think I want to get a little bit more bullish going into 2024. The Fed is becoming a couple of words that they've also said recently. A lot of the Fed speakers or Fed members is what I should say, is that they're becoming a little less hawkish, in that on November 1st, the probability of them raising a quarter point is now down to about 15%. There's been a lot of volatility in that probability, actually, the marketplace trying to guess if the Fed is going to raise interest rates by a 0.25%, or if they're just going to leave things be the way it is. And right now it's leaning towards leave things be. So the marketplace, it's prime. Not everything is perfect. Oil is still kind of a concern, especially with what's going on in Israel. So the price of oil is the one thing that has came off a little bit recently, but is still trading fairly high and adding to inflation concerns. Okay. So that is buying a stock, the leap as a stock substitute. So now I am going to go and pull up the TradeHawk software again. And let's get into the Google trade. And now, before I do this, I'm only going to say this once. If you have any questions and you are on in YouTube, please put them in the chat box. I like this to be an interactive show. We're going to kind of kick off this little portfolio thing that I'm planning to do by buying these deep in the money option contracts. I'm going to try to diversify my portfolio, and I'm going to try to get long some of these underlyings. Now, in a normal portfolio, I might add some stock with it, but this portfolio, we're just going to stick with the option contracts, and we're going to paper trade them, and we're going to follow it throughout 2024 and take a peek at it every once in a while and just see how things are doing. So in this expiration, I'm going to run all the way out. We have all the expirations across the top here. And we see that this is the January, February 2023, 190 days away. We're going all the way out to like 345 days. I think we're going to do let's go even more. Let's go out to the January. Here we go. So we're going to put this out to January 17th. We're going to have to go deep in the money. This is going to be a real option contract. And the reason why I want to go out to 465 days is we're going to put it off to the next year. We're going to go out more than a year. But as far as taxes are concerned, if you're not in a retirement account, you would like to have that ability to be able to sell your option contract or exercise or do whatever you want to do all the way out into 2025. So that's going to be the expiration that we're going to focus on whenever we're putting these trades together. That's what we're going to look to do. Now, they're going to be expensive option contracts. And if I scroll down, which I'm slowing down here a little bit, if I scroll down, I'm going to concentrate over here on the delta. So in order to pull this trade off, it's 105 is where we're at. That's right at 80 delta. If we look at the 100, which is a nice round number, I wouldn't mind buying that one, but that's at 82 delta. I don't want to have to pay up for that. So I'm going to look at buying the 105 strike. We're going to look at the 2025 January 17th option contract. So we're going all the way out beyond 2024 into 2025. And that's the contract that a lot of people like. So you'll see sometimes that the January option contract will have a little bit higher open interest on these leap options that go out that far in time, mainly because there is some advantage on a tax. And this isn't a tax show, but there's some tax advantages to the ability to close that position all the way out in 2025. All right, so we're going to do the 105, and it's going to be quite simple. We see the ask price here. We're going to buy the 48.50. And in this instance, we're long the 105 call. We have a delta of about 80 cents. We're trying to trade it. We'll see. We got some open interest. We got 2,244 contracts, not too shabby. The bid-ask spread is a little bit wide on this. I think I'm going to give them a little bit. I'm going to make the math simple here, and we're going to say we're going to execute this for 47. All right. So here's the downside of leap options and honestly, if this wasn't the case, I don't know how many stocks I would actually trade in a longer term portfolio. But the bid-ask spread is much wider in the deep in the money long-term option contracts than it is on the stock. And that's a battle that you have to fight. There's no doubt about that. Part of the benefit of it, though, is that you have a longer time for this to actually kind of pan out on your position. And I'm only going to get out if the underlying stock starts coming down towards my strike price. I have a pretty much a hard out price at my 105 strike on the downside. So if you could get penny-wide stocks in the long-term option contracts like you do in buying the stock outright. Like right now, if I look at the Google bid-ask, we're a penny wide on the bid-ask, if that. And on the option contract, we're, $1.50. So that is the issue, and that's what you're battling all the time. So I'm not going to be doing leap options in even stock like Walmart. it just doesn't really have I would have to look at the marketplace. Maybe Walmart is liquid enough, but I don't want to have a $2 or $3 bid ask spread going all the way out to that January 2025 option contract. So that's the biggest issue with this strategy, is trying to battle the bid ask spread. Okay, so now as we go back, that is going to be that option contract, and I don't mind just buying this option outright. I don't have any problem with that. But at this point in time, I'm going to sell a call against it. We're in October. Markets are still a little sketchy. You got to manage that call, but we're going to sell a shorter term call against that. So we're going to have to come all the way back to the shorter term option contract. So October 13th is 2 days away. I'm going to err to the side of going shorter term as opposed to longer term to give up premium. I'm going to stick right in that 16-day mark. And we're going to go down and look at an out of the money option contract. If we go 16 days, one standard deviation is about 150. Delta's 18 on that. So it's right around that 150 mark. I like that price of $1. So this is the contract that I'm going to sell. I'm going to sell the 97 strike call. Now you might say, well, $1, what is that? Well, on a $47 option contract, it's not too shabby, right? On a percentage basis, that's not that big of a deal. If we were doing it on Google, I might actually go and sell maybe the 147 or the 146, which is trading for right around $2 here. I'm pointing to it on the screen, but I don't mind that as much with owning the underlying stock, because if it gets called away, I'm just selling it at a higher price. My issue when you do a long-term option as a substitute for the stock is really don't want to be assigned. So I'm going to err to the side of doing shorter term options and going a little bit further out and pulling in less premium. And that is not as bad because I have a lower priced underlying as opposed to buying that stock outright. So this is where it's at. This is going to be our paper trade for the week. This is going to be the start of our 2024 longer term portfolio of deep in the money option contracts. And I guess I don't see any questions here. So with that said, I think this is going to be it for this edition of Options Guide TV. We'll come back on Friday. We'll look at how our short-term iron condor is doing. Hopefully it's still staying within the range. Think about adjusting that trade. And then we'll take a peek at what's going on with the Google long-term fig leaf position that we just added here. Thanks for coming, everyone. Please click subscribe, ring the bell, and pound that thumbs up. It helps me a lot here on Options Guide TV. And we'll see you this Friday for the next edition of Options Guide TV.